So let me kind of dive in here a little bit, and let me begin with the usual. Whenever hear somebody from the Federal Reserve talk, you almost invariably hear the disclaimer, and that is, we didn't take the time to clear every remark with Chairman Bernanke or anybody else in the Federal Reserve System. So when we speak today, it's really on our own behalf. So any responses or comments that we make are our own and don't represent the Federal Reserve System or the Chairman of the Federal Reserve, certainly. And let me just briefly show you the agenda or our plan for the day. I'm going to make a few comments about how the Federal Reserve is audited. And then after that, Paul will cover where our financial statements lie, where you can find more information about the Federal Reserve financial statements. He'll talk about the Federal Reserve asset trends, the statements of comprehensive income, the statement of condition, and the summary. And the real purpose, certainly we're going to dive into the numbers here. We want to give you a sense of, a lot of people think the way to really understand what's happening in an organization is to look at their financial statements. So this is another way to understand about how the Federal Reserve is run, how we're operated, and how that's reflected, not just in this reserve bank, in the whole Federal Reserve System, in our financial statements as a whole. Before I kick off this session and have Paul talk about this, I want to just provide a little background about the Federal Reserve System. A number of you probably know a lot about the Fed. Some of you maybe just know a bit. But let me just take a few seconds to talk about who we are, what we do, and how we do it. So the Fed, I think people know, is overseen by the Federal Reserve Board. And the Federal Reserve Board in Washington, D.C. is a government agency. At the same time, there's 12 reserve banks all around the country. Those were established in 1914. We have our general ledger back there from our first year of existence. And they're essentially operating arms of the Federal Reserve System. And we are not government employees, for example. This is corporations incorporated under the laws of the United States, under this Federal Reserve Act. Now, we do, many of our operations seem almost like private companies in some ways. We compete with financial institutions by providing services to other financial institutions, for example. Many of those are more public responsibilities, like supervisory, bank supervisory responsibilities. We go out and examine banks to make sure they're safe and sound, for example. And certainly one of the key things when you think about the Federal Reserve is the role of monetary policy, and that's essentially a governmental function. And when you again, the balance of how the Federal Reserve is operated, how it began in 1913, is reflected in how monetary policy begins and how it's implemented in the Fed and in the United States. As an example, we have 7 governors that are located in Washington. In fact, 2 were very recently appointed to be governors of the Federal Reserve System. They're appointed by the President, confirmed by the Senate. And then there are 12 Reserve Bank presidents. Narayana Lakota is not a governmental appointee. He was appointed by our Board of Directors, confirmed by the Board of Governors, and he's the President of this Reserve Bank. Those 7 governors and the 12 Reserve Bank presidents serve on this organization called the Federal Open Market Committee. And that committee really represents that balance of government and private, and that's that carefully, balanced approach that not only reflects government and private, but also a decentralized system. The idea is to gain as much information about what's happening in the economy, for example, in the 9th Federal Reserve District that runs from Montana, North and South Dakota, Minnesota, Upper Peninsula, Michigan, and Northwest Wisconsin for our district, so that we get a lot of input from our Board of Directors that's passed on to Narayana Lakota, who goes to the FOMC meeting and provides that information to the full membership, to the Chairman Bernanke and the rest of the Federal Open Market Committee. So that monetary policy is a big part of, when you think of what the Federal Reserve does, it's a big part of what we do. We also have a role in financial stability, where we keep financial markets stable and we're working for credit-worthy borrowers, individuals, and businesses. In this way, you saw this during the period of the crisis, the financial crisis, where the Federal Reserve made what we call normal discount window lending, where we make short-term loans available to banks, credit-worthy borrowers, on a short-term basis, where that loan is collateralized, where we have legal right to collect that loan. We also made some extraordinary actions, which the chairman talked about in March, in which we have some articles that were written in our Region magazine over the last couple of years that speak to more broad-based lending programs that were well beyond financial institutions. And with respect to all of those activities, the Federal Reserve has never lost a single dollar on a loan we've made to a financial institution or other institution as part of those lending programs, because they take a lot of collateral. We make sure that we're legally covered. So you can rest assured that we're handling those financial stability responsibilities effectively. At the same time, as I mentioned, we are bank supervisors. So we supervise what's called member banks, banks that are members of the Federal Reserve System, state member banks in this case. So we supervise state member banks that are chartered by the state and choose to be members of the Fed. We also supervise what are called bank holding companies, organizations that are on top of banks and also thrift holding companies under the new Dodd-Frank Act. There we examine them for safety and soundness, looking for their capital, their quality of capital, their asset quality, their management, earnings, liquidity, and sensitivity to market risk. We also do consumer compliance examinations to ensure that they comply with the various consumer laws and regulations. Then getting to this payment services, we also provide reliable processing for trillions of dollars of payments for the nation's banks and for the federal government. And in this way, we provide currency. If you've ever been on a tour of this bank, and we have bank tours that are available. If you go online on our website, you can sign up for a bank tour, go down to the cash department, and you can actually see at any one time, millions of dollars of cash coming in the bank. We process it, and then it eventually leaves the bank to go to the financial institutions that order it from us to provide it to their customers. We also facilitate the process for wire transfers among banks and for what we call ACH, or automated clearinghouse payments. In fact, in this reserve bank, we're the one district that provides the system by which those payments go from, say, your employer in the form of a ACH payment to you as an individual for your paycheck. So that is done here in Minneapolis. Likewise, we're the district on behalf of the whole country. If people order saving bonds or treasury notes from the U.S. Treasury, that happens here in this reserve bank for the entire country. So we have a number of operations that we're finding, much like other financial institutions, were previously done in many sites around the Federal Reserve System. We've consolidated those to a single place, and we do many of those types of operations here in Minneapolis. And lastly, an important aspect of what we do is in the area of community engagement. We work with communities, nonprofit organizations, lenders, educators, and others across the nation to provide financial and economic literacy, attempt to address housing problems, promote equal access to credit, and advance economic and community development. We have a group called the Community Development and Outreach Department. Dorothy Bridges, who is formerly a community banker, is the senior officer responsible for that function. So that gives you a sense of what we do. And the last thing I want to turn to before I turn things over to Paul is kind of how we want to do things. And a big aspect, I think, of the Federal Reserve, and we actually learned this as part of the crisis, is to be forthcoming with the public and to try to educate the public as much as possible about what we do. And that certainly took place prior to the crisis, and especially in an area like monetary policy, where the chairman reports on a semi-annual basis to Congress about what's happening with monetary policy. Policy makers like Narayana Coach Lakota here at this Reserve Bank provides frequent speeches about his views on the direction of the U.S. economy, what could be done, what should be done in his public speeches that can be found on the website. Likewise, the other 11 Reserve Banks presidents are all doing the same kinds of things with the governors to give people a sense of what's happening. And even the transcripts and the minutes of the meetings are ultimately released so that people have a sense of what they talk about when they're talking about monetary policy around that Federal Open Market Committee table. So there is a great deal of emphasis on transparency, but then also accountability, and a big part of accountability, I think, has to do with the fact that the Fed is audited. There was some question prior to Dodd-Frank. Legislators and others asked, well, what's the process for audits in the Federal Reserve? And one of the things that's on the very front page of the Board of Governors website is this exact bar that says, does the Federal Reserve get audited? And the answer is yes. And I think Linda would even, if you had more questions about this, Linda would be happy to talk about it. This is also on the board's website, but it talks about all the ways that the Fed is in fact audited. Starting off is we have an outside auditor, Deloitte & Touche, that provides annual audits of our financial statements. We're subject to reviews by the GAO that provides numerous reviews of Federal Reserve activity. And there's actually a list, if you go out to the website, a list of all the audits that's done, and you can actually click and review those various audits by the GAO. Likewise, the Office of Inspector General, which is under the auspices of the Board of Governors, reviews the financial statements, and they also investigate Board of Governors programs and operations. For example, when we have a bank failure, we have bank examiners are going out to evaluate member banks. When there's a bank failure, the Office of Inspector General issues a material loss review where they go in, they interview our bank examiners and say, what happened? We know that, that the bank probably didn't do as good a job on this as they could have, but the other question is, you had a bunch of bank supervisors that are out evaluating that bank. What kind of job did you do? What kind of job did your management do? And what could you learn from that? Those material loss reviews are also public, can be found on the OIG website. We also have an internal audit department. Linda is the head of that area, and we're also subject to annual evaluations and examinations by the Board of Governors. So I want to give you a sense of the range of activities, the range of oversight responsibilities when it comes to reviewing and evaluating the Federal Reserve System. So I'd like to now turn it over to Paul, and I think I would like to also encourage you, since we have a relatively small group, I'd be happy to hang on to this microphone. If you have any questions midstream during his presentation, he has maybe 20 to 30 minutes of talking, you should feel free to interrupt him in the middle of his talk, raise your hand, we'll get a microphone to you and you can raise those questions during his talk. But before he does, let me see if you had any questions about my very brief overview of the Federal Reserve System and especially any aspects of how the Federal Reserve is reviewed or audited. I'd be happy to respond to those. Any questions on that? Okay. Paul, I'm going to turn it over to you, and you have now control of the clicker.
I have the power.
Yes.
Can everyone hear me fine? Thank you. Well, before we get into the financial statements, let's talk a little bit about availability of this information. So we have our bank website, which I'm guessing most of you are familiar with. Right on the front page, in the middle, there's a spotlight section, and about 2/3 of the way down, there's a link to our financial statements for 2011. That information is also available before this meeting. So if you pull that up, you get the report that Deloitte & Touche issued for 2011, which also includes 2010. So in that financial statement is a report from management on our internal controls. It's a pretty standard financial statements. You've got the opinion from Deloitte & Touche. Then you've got our statement of condition or balance sheet, our statement of income, our statement of changes in capital, and our footnotes. So I'm going to highlight a few things from that tonight, but just to kind of give you where that information is. Also, right below that link, there's a link to the Board of Governors website, and it brings up a lot more financial information. So the first thing that I wanted to highlight, and there's actually a lot more out there that I'm going to highlight for you, but these are kind of the key ones that relate to the financial statements and financial information. So we've got weekly publication of Federal Reserve balance sheets. Now this is actually a 10-table report, but the last table, Table 9, has the balance sheets for each reserve bank for that week. And that information is out there, goes back many years, so it's weekly information that's available at that site. And actually, my next slide, and hopefully you haven't looked ahead, but there's a graph. I actually use that data, so it's from that site and that information. And then there's the annual publication of all the Reserve Bank's financial statements out there. So not only is ours out there, but the other 11 Reserve Banks is out there. The Board of Governors is out there. A combination of all the Reserve Banks is out there. And it's not only out there for this year, but it goes back 5 years. So all that information is out there also. And then also out there is a nice charting feature and descriptive information on what a lot of our accounts mean. So you can kind of do graphs, like I did on the next page, but kind of graphs and trends for the last 5 years. So beyond that information, there's a lot of information out there too related to the financial crisis and a lot of the actions and programs we put in place. So here's the graph I put together using information from weekly balance sheet information. So this represents all 12 Reserve Banks, total for the 12 banks. The reason I want to talk about this first before I get into the financial statements, I think this helps us understand what's happened in the last 5 years to our financial statements. And kind of, so this is all 12 Reserve Banks, combination of all the 12. But every bank's balance sheet kind of looks similar or has the same trends. Just to kind of orient you here, so we go from the end of 2007 into March of 2012. If we'd gone to June of 2012, it hasn't changed much in the last 3 months. So you've got that period of time. You've got the change in the Federal Reserve System assets. We go from about $900 billion to, we were about $2.9 billion at the end of 2011. So it's roughly tripled. And if you were to look at, if you were to take this graph and go before 2007, back to 1914 if we wanted to, it's a pretty boring picture because it's pretty much a straight line, slightly, if we're going backwards, it's descending. If we're going forward, it's ascending. But it's pretty much a slowly increasing line at 2 to 3%, pretty much from when the Federal Reserve was created into 2007. And you'll notice here this bottom green section is the largest component of our assets back in 2007. And that would be true going all the way back. Those are the Treasury securities we own. It's related to our monetary policy actions that Niel referred to a little bit. So before 2007, pretty stable, not a lot happening with Federal Reserve System assets. And then you can see a lot of different colors entered the picture starting in 2008. Now, one thing I want to point out, you'll notice there's multiple shades of green in this chart. These items make up what we call as a system open market account, which the New York Fed manages for all reserve banks, and they take direction from the Federal Open Market Committee that Niel talked about. So any actions that that group decides, the New York Fed implements, but then that's allocated to all 12 reserve banks. So that's why what happens with those green items affects all 12 banks, and it affects them in the same proportion. Now, we all get different components or share. In fact, our bank gets 1.5% of those actions, and I'll explain why that is in a little bit, which is the smallest of the 12 reserve banks. So what you see in the green here affects all reserve banks. So just to kind of highlight a few things here, we have Treasury securities, and then about 2009, we had a couple large asset purchase programs start. We had one here, sometimes called quantitative easing 1, and another one here called quantitative easing 2. We also started buying mortgage-backed securities at that time. So all that information, all those assets, related income, and expenses were allocated to the reserve banks. And so that affects our financial statements tremendously. Point for the slide here. You'll also notice in 2008, we got some purples and some blues enter the picture. The purples are the things Niel talked about with the lending. So the more bold purple is our traditional lending. And then the lighter purple is the term auction facility. And that lending stays in the books of the bank that made the loan. And every bank saw an increase in lending in that time because of the liquidity issues we're having. You'll also notice there's some blue up there and some yellow, and those actions were kind of unique to certain reserve banks. And those actions stayed on those reserve banks because they were the ones doing the lending or taking the actions. So the ones that are affected our bank are the greens, various shades of green, and then the purple in there. So let me stop there and see if there's any questions on the graph, because it kind of shows what's happened from a policy program perspective, but it also is what really affects our financial statements. Niel went over I'll get you in a second. Niel went over the roles of the Fed. Monetary policy dominates our financial statements. I mean, we do all these other things he talked about, but as far as what affects our statement of condition and our income statement, it's monetary policy. And this graph kind of highlights a lot of that. So, get a question?
Wait, hold on a second. Let me give you this.
The AIG loans.
The AIG loans was all handled by the New York Fed.
Yeah,
so that's the yellow up there. You can see
that's
it's
what we have
dwindled
left.
over time.
I mean, really, you look at all the lending activity that takes place, everything is pretty much paid off except there's a bit of AIG loans that are left. That's really the remaining loans outstanding, I believe,
Right.
really it from the crisis period.
Yeah.
Hold on a second, Bob.
So where did the cash come from to buy these assets?
Great question. So where did the cash come from to buy these assets? Well, we're the central bank. We control the money supply, and money supply. We, in essence, just purchase them. When we buy them, we basically create money. So we're increasing the money in circulation. So in essence, when we bought these securities, we have some primary dealers we work with, which are large financial institutions. When we went into, let's say, quantitative easing 1, we decided to do that program to influence interest rates. We, in essence, went out and bought securities by crediting these accounts, and I'll explain that in a second, the accounts of these financial institutions. So that put more money into circulation, or electronic money in this case. But so as a central bank, that is one of our capabilities.
Hold on. Oh, go ahead, Dave.
I'm wondering on the chart here, the ABCP MMMF facility, could you address that?
I might actually, I don't remember much about that one. I think it was a money market facility that either the
It involves commercial paper. So there were a large number of credit markets that were frozen, and among them was the commercial paper market. So there was, a range of programs, not just for banks, but for a large number of markets that basically provided more liquidity during a time when basically everyone was unloading large numbers of assets because they were looking for liquidity. So the Fed bought those assets or lent against those assets to allow people to, on a temporary basis, to have cash available to pay obligations. When the crisis was averted, you see over time that those obligations started coming down. And that happened with the commercial paper market. It happened with primary dealers. A large number of not just banking institutions, but a range of pretty much every financial market during this, basically the September, October, November of 2008, where you see all of those activities start to spike. There's a question over here too.
You said in the QE2 there was a lot of mortgage-backed securities purchased. What's the methodology, or from whom do you buy them and why? Or was it banks were forced to sell them, or?
The reason we bought them was to push down long-term interest rates, particularly mortgage rates, to facilitate that market. And the way we purchased them is, again, sometimes working with these primary dealers or directly, but they're mortgage-backed securities issued by government agencies like Fannie Mae. So they're fully insured and backed by the U.S. government. So there's no risk of loss to us in purchasing those securities.
These are newly created mortgages, or were they?
Typically, I think they're newly created. They could be, secondary sales, but I think they're primarily newly created mortgages. So.
They're really good questions. Are there?
And one more.
Let's see if there's others. Yeah.
You said that all the feds can create money. What controls do you have when you create money to prevent inflation?
I was going to.
That's a great question.
It's a good. That's a good link to our economist,
Is that
Toby
teaser,
Madden.
right?
I remember looking back in the time when money was just growing steadily over a long period of time, and I looked at the weekly report, and it was just like off the charts. And I couldn't get to sleep that night going, oh my God, we're going to have 3 times the amount of inflation. We're just going to have 300% inflation. And I'm tossing and turning all night. So I go up the next morning to Art Rolnick. I'm going, Art, look at this. And he said, relax, Toby. The money's coming back at us. Normally, we put out the money, and it's multiplied through the fractional banking system through loans. But what was happening is we'd push out the money. What has happened and it's still happening, we push out the money, and the money comes right back at us in the form of excess reserves. In other words, the money gets pushed out, put into banks, the banks give it back to us. And that's the reason we're not seeing inflation at this time.
Go ahead, Toby. Or Dave.
So say when the Minneapolis Fed decides to purchase assets, you don't have.
The New York Fed actually does that on behalf of all reserve banks. So, and then we just allocate our share of it. So, but
Oh, all right. Okay.
So,
the
yeah,
New
let
York-
me just add on that a little bit if I could. So this Federal Open Market Committee that I talked about, the set of policymakers, the Board of Governors, and the presidents that serve on that group, presidents actually rotate in their voting process, but they provide direction to the open market desks in New York. When it comes to monetary policy actions like the purchase of mortgage-backed securities, et cetera, that comes from a direction from that policy desk in New York, from the FOMC. So us as an operating arm at little Minneapolis here, we can't provide that kind of direction. That has to come from the New York, from the FOMC to the New York Fed, who does the work of the policy group.
Okay. That makes sense.
Yep.
And that policy action is a statement that's issued after every meeting. So it's a very public declaration of what we're going to do.
Okay.
So sometimes you see the people on Wall Street waiting, for the two 2 p.m. or whenever that announcement's made.
So when those decisions are made, well, you don't have to wait for QE1 or QE2 or the next, QE3 to make these kinds of decisions. So in a sense, there is the capability to purchase these assets on an ongoing basis. It's just not news. So why is that not as newsworthy as QE1 and QE2? Because of the scale?
Well, typically our practice had been, if you go before the crisis, we just basically purchased materials. The only time we purchased is when something matured or to function a little bit of growth, just to have growth in the money supply. But we typically held a security till it matured, and then we replaced it. We didn't go out and add assets, as you can see from the picture here. So,
got it. Okay.
I mean, we had the capability to do it.
Sure.
But it was a policy decision.
Okay.
There's another question back here. Hold on.
How do you curb the inflation on a global scale when the dollar's the international money standard? If someone in another country needs a certain amount of money for, say, a barrel of oil, how do you double the money supply and then have them accept the same amount of money for the same product?
Again, the money gets pushed out into the system and then it comes back to us. So when we're saying that there's extra money out there, well, it is for one time and then it comes back. And so the oil markets work with supply and demand changes and through the foreign currency markets.
Toby talked earlier about the bank reserves that are currently held. So Paul's here talking about the asset side. It might be useful to show. Do we have a liability side? Okay, these are numbers.
We don't have a graph like
we don't have a graph, but that deposit, was it the deposit number, Paul?
The deposit numbers are right here.
Yeah.
So this is just our bank. So at the end of 2011, we had $9 billion in deposits. These are financial institutions holding deposits with us. If you looked at the system level, that's about $1.5 trillion. If you go pre-crisis, it's like $20 billion. So that's where the growth, you see the growth in the assets on one side and then it's the growth in the deposits on the other side, like Toby's been talking about.
Yeah, so when Toby talks about the money coming back, banks are basically deciding to hold their funds here in the reserve bank, just like we're their bank. And they're getting, how much money are they getting on
They're
their
getting
reserves?
25 basis points, so 0.25%.
Yeah, so not as good as your CDs, but not much, not that much worse. So they're getting a little return for holding it here. But their other option, of course, is to lend that money. I mean, that's the other option. In some cases they choose to do that. In other cases they're deciding they're going to hold it in reserve here. Question over here.
Is gold part of the assets, and do you guys have any effect on the gold market, or is all this basically?
Can I hold the first part of the question until I get to our statement of condition? Because we do. The answer is no, but okay.
These are, well, Paul, let's maybe return back to your, these are great questions, by the way, and this is exactly what we're hoping for, so keep them coming. So any more you want to talk about this asset trend
I've
slide?
said all I
okay.
had planned, but any questions specifically on this? And then we can move on to the financial statements and then maybe get back to some of the economic questions that stem from this at the end.
I think it's fair to say as a summary, all those colors in the midst there were in response to the crisis. Since then, our monetary policy actions really designed to help facilitate growth. Mm-hmm. So is that a fair summary? I mean, I think that's the whole idea. So that's why you're still seeing a fairly large balance sheet on the Fed. It isn't because we're still we're still making loans, because if you look at the bank loans we're making now, or any loans, they're tiny. Occasionally a bank says, you know what, overnight I need a little money because I got a lot of checks to pay. And we make those loans, we get collateral, and then they pay it the next day. So we're seeing some of that. Nothing like, of course, we're seeing that time period, but we're still seeing a lot of what they call accommodation, monetary policy accommodation that's reflected in this balance sheet. That's what's going on here. All right.
So let's move ahead and then...
yeah, we can come back to this if need be, too. Now we're getting into small numbers.
Well,
there won't be any tests.
So this is page 6 of our financial statements. This is our income statement. Like Niel said, the numbers are small. So what I've done is on the next page, I've summarized this. We can certainly come back and take detailed questions on any of these, but just to make it a little easier on the eyes, this is the same information just at a higher level. So this is our income statement for both 2011 and 2010. As you can see at the top, we have interest income of over $1 billion, over $1.2 billion in 2011. And that interest is the earnings, the interest that's on those Treasury securities and those mortgage-backed securities I just showed you on the graph. So that's how the Fed gets their primary income, is interest off the securities we hold for monetary policy purposes. Now, if you went back a number of years, this number is probably half the size because we didn't have as many assets. Rates were a little higher then, but the size of the assets makes a big difference. So we've got interest of over $1.2 billion for this district. And like I said before, our numbers in this area are about 1.5% of the system total. So if you want to get a sense for where the system is at, you can kind of do that math real quickly.
And again, the largest balance sheet is New York.
New York
right?
should be.
So what percentage of the total are they, Paul?
They just went over 50% of the assets. Okay. So they, you know, in the system we have 2.9 trillion assets. Theirs is about half that. Then we have interest expense. Neil, we just talked about this. This is the 25 basis points we pay on deposits. So that was $24 million in 2011. It was down a little bit from 2010, just because on average we held less deposits this year than last year, mainly due to some merger activity between our district and another district I'll highlight in a second. So we have net interest income of $1.2 billion. Then we have some non-interest income. Some of this is related to, we did sell some securities for gain out of our portfolio. We have some income related to some of the financial services we provide that Neil mentioned, like automated clearinghouse and funds transfer. And then we also do some work for the Treasury, and they reimburse us for that, like some of the Treasury work that Neil talked about in savings bonds. And then we have our operating expenses and other expenses. The primary piece here would be compensation for bank employees. That piece is about half of the $199 million. So then we get down to comprehensive or net income of $1.1 billion for this district. System-wide, that number was about $77 billion this year. If you go back pre-crisis, it was about 30 to $35 billion. The reason it's much higher is we're holding a lot more assets, generating a lot more income.
So that $75 billion or so last year was turned over to the Treasury, right?
Yeah, we'll get to that. So nice lead in.
Sorry, I don't want to take away your thunder.
Nice lead in. The one thing I want to point out here, though, is if you remember back to the graph, we purchased assets, we did liquidity actions for the betterment of the economy, for monetary policy purposes. We did not consider profit at all when we took those actions. It just so happens we generate a lot of income, and so we are quite profitable, but that's not the motive of our operation. So profit maximization is not a factor when we make our decisions. We want to operate efficiently and control our costs, but on the income side, it's really done for monetary policy purposes. So as Neil just alluded to, so we have $1.1 billion of income this year, and by law, we're to pay dividends to our members, which is 6% set by law. So that's $28 million here. We also have, and I'll talk a little bit more about this when we get to our statement of condition, we retain some of our earnings, and we call it surplus, equal to the amount of our capital. And we had a change in capital in 2011 where we actually were needed to hold less surplus. So in essence, it freed up some surplus or retained earnings on our statements. That's the $709 million. And then the remaining is returned to the Treasury. So we paid to the Treasury $1.8 billion last year. So another way to say that, it might be a little confusing here, is we had income of about $1.1 billion. We had some excess surplus of $700 million. And add the two together, and you get about the $1.8 billion we return to the Treasury. System-wide, it's about $75 billion that was returned to the Treasury. Go pre-crisis, it was $30 billion roughly. And actually, we make those payments on a weekly basis. So every week, every Wednesday, we figure out what our net earnings are, and we send that to the Treasury. Yes?
It's somewhat circular then, because your earnings are interest payments on Treasury bonds, and then every week you send that interest payment back.
True. Yes. Yes. The U.S. government, since we're buying Treasury securities and agency mortgage-backed securities, it is interest that they're paying to us that we return to them. The excess, yes. Good question.
Hold on one second.
Can you explain that, that 709?
Can I hold that till I get to the statement of condition? Because I think it'll be a lot clearer when I get to
Okay.
the statement of condition or balance sheet, yeah. There's the relationship between the two, and it's a lot easier when I get to that one, so.
Could you elaborate on the dividends paid to member banks? How is that portioned or proportioned? Does a member bank get dividends regardless of their activity with the Fed?
Yes. So member banks, one of the benefits or requirements of being a member is they have to purchase stock in the Federal Reserve, and it's what they pay in is 3% roughly of their capital and surplus. So that's stock they own in us. That's our capital paid in, and then on that balance we pay 6% a year. It's actually we pay 3% semi-annually. So it has no relationship to how active they are with the Federal Reserve or not. It's just based on their membership and their capital paid in.
Each member bank may have a different amount of ownership or a different amount of stock interest.
It would vary just because their capital and surplus would vary. So it's proportionate to their size. So a larger bank
just
will
their
hold more
size.
capital with the Fed than a smaller bank would.
Thank you.
Hi, can you dwell on the interest on reserves that you were talking about? It's 25 basis points. Isn't that counterproductive to stimulus to the economy? And wouldn't the Treasury be upset about that? I know the banks would like that. But
Toby, you want to take
yeah.
that one, or you want me to take that one?
Sure, it is somewhat counterproductive because we're giving an incentive to banks to come hold their funds with us rather than lending it out. But it's a very small disincentive at only 0.25%. So.
Yeah, that is a capability we didn't have till the end of 2008. Prior to 2008, there was no interest paid on deposits with the Fed. So that was a new tool that Congress enacted, effective in 2008, to pay interest on reserves. At some point, I would expect that rate to go up as interest rates in the whole economy go up. But that's a decision for the Federal Open Market Committee to make. They're the ones who weigh in on that decision. Any other questions on our income statement? So the Federal Reserve funds their operations with the interest income we earn on our portfolio of Treasury securities and agency securities. We don't, as Niel kind of alluded to our organization, we don't go before Congress for appropriations. We're not part of that. We're an independent entity, self-funding. And so this is how income statement kind of shows how we do that. Okay, we can come back to this at the end if there's questions on it. So, once again, so here's our statement of condition or balance sheet from our published annual report. Once again, it's kind of small. So I've summarized it here, mainly by key categories and things I wanted to emphasize.
I note, Paul, to return back to a question.
Yep.
Gold is on the detail, but it's not on the summary. So do you want to talk a little bit about gold?
Yeah, let me take that first. So if you look on the detailed one, at the very top, there's something called gold certificates. What that is we don't hold that gold either. The U.S. government holds that gold. But to monetize that or to turn it into a useful form, they've issued a certificate to us, and we basically credit their account for the amount of that certificate. In our case, it's $197 million. So the Fed doesn't own any gold, so to speak, of any magnitude. The New York Fed actually acts as a custodian for a lot of gold, but they don't have ownership in that. So the Fed doesn't own the gold. The U.S. government owns the gold, and when they want to monetize it, they'll issue a certificate for us. Now, this balance hasn't changed in years. I don't know the last time that they've actually needed to monetize any of that. So
it's slightly different back in 1914, I see, Paul.
Yeah, I noticed that earlier.
Because the gold certificates is a line item.
Yeah.
Also, gold bullion is also a line item in
I can't speak to
1914.
that, but I'm not sure.
Okay,
what
all
happened.
right. But I just thought I would note that you're right. It hasn't changed, but it's a little different than 1914.
Yeah, so here's a summarized version of our balance sheet. So a couple things I want to highlight. You know, if you look at total assets, $46.3 billion. Once again, that's roughly 1.5% of the system total. System total is right in that $2.9 trillion range. But if you look up at the top, we've got coin of $60 million. And then if you look under liabilities and capital, there's something called Federal Reserve notes, almost $16 billion. Well, in almost every other entity's balance sheet, you would have a cash account and it would be an asset. Well, in our balance sheet, we've got the coin account as an asset, but the currency, which is what Federal Reserve notes are, as a liability.
That should drive you a little crazy if you're an accountant.
When I first started at the Fed, it took me a while to figure this out. So here's the difference.
Yeah.
So the coin of 60 million, that's our inventory of coin here. The U.S. Mint mints it for the U.S. Treasury. We buy it from them to distribute to financial institutions to meet their needs. So it's what we're showing as a balance is just the coin we're holding here or in other locations. So it's just it's an inventory type item almost. Whereas Federal Reserve notes, so if you look at your currency in your pocket and hand it all to me, I'm just kidding. But if you look at your currency, it says Federal Reserve notes on the top. The Federal Reserve issues the currency. We stand behind the currency. We're the ones liable for the currency. So that's why it's a liability for us. Whereas coin, we're really just distributing that for the Treasury. So there's a big difference in kind of the origin of those two. That makes for the difference between the two. Now for coin, I said that's just our inventory. For the Federal Reserve notes, and if you look at your notes, there's like I-9 notes, there's A1 notes, there's B2 notes. That designates the Reserve Bank that were issued on behalf of, and we're I-9, 9th District, 9th letter. So the balance here represents I-9 notes that have been issued and are outstanding, less what we would hold in our vaults downstairs. So it's almost $16 billion. System-wide, that number is about $1 trillion. Okay, so we're at about 15, 16 billion. System-wide's $1 trillion. That's about 1.5%, right? That's roughly why we get 1.5% of the allocation I talked about earlier. It's kind of based on, not totally, the formula is a little more complicated, but a lot of it's based on Federal Reserve notes outstanding. So everyone comfortable and understand why Federal Reserve notes are a liability. Okay, a couple of other things to point out. You'll see that the next two assets, U.S. Treasury, these are the things off that graph that I talked about. These are the green things. So we've got U.S. Treasury securities and other securities. The other is the mortgage-backed securities. That's $41.5 billion on our balance sheet. It's 90% of our balance sheet there. And then the foreign assets and currency swaps are almost $4 billion on our balance sheet. So, and those are all allocated once again to each reserve bank, and this is our share from the New York Fed. So that makes up our balance sheet. Once again, it's almost all of our assets are kind of really monetary policy type activity related. Looking at the liabilities, we already talked about Federal Reserve notes. Then we have depository institution deposit. We've already talked about that a little bit. So at the end of 2011, that was $9 billion. End of last year was $6.6 billion. That number actually can bounce around quite a bit on our financial statements on a day-to-day because there's a lot of activity between reserve banks resulting from activity of financial institutions between reserve banks. Then we have something called the interdistrict settlement account. For you accountants out there, that's like an intercompany account. So that's for transactions between reserve banks. At the system level, the balance is zero. So for an example, when the New York Fed allocates the securities they purchase to all the reserve banks, we in essence buy that from them through this account. So it's kind of how we handle transfers between reserve banks. A lot of times there's these depository institution accounts, there's transactions between reserve banks. The offset is in this account. So it's an internal accounting transfer account. Capital paid in and surplus. And I'll get back to explaining this here. So you can see a big drop in our capital and paid in and surplus from 2010 to 2011. Went from 1.6 billion to 220 million. And half that balance represents capital paid in and half of it's surplus. So at the end of 2011, we had capital paid in of 110 million and had surplus of 110 million. So the 110 million was the 3% that member banks had purchased in the Fed, 3% of their capital and surplus. The reason we had a big drop, and we see this, it's not unusual, is because of merger activities amongst financial institutions. You'll see capital go up and down between reserve banks because an institution in or actually more than one institution, our district merged with an out-of-district institution. So it's capital moving from one bank to another. At the system level, this number stayed about $26 billion. 26 billion? Yeah, 26 billion. So there wasn't a change in capital system-wide. It's just because of merger activity and where the charter was located between some banks that our capital went down, offset was in another district. That's also why our dividends went down. And then, so that's 110 of the 220 million. We then retain, like I said earlier, we retain surplus our earnings equal to our capital paid in. So in this case, that's 110 million. We had been holding a lot more. We've been holding 800 million in surplus, half of the 1.6 billion. So we had 800 million. We now only needed 100 million, 110. That's roughly 700 million. So that's the 700 million on the previous page, where I was talking about we had surplus freed up, and we returned that to Treasury. So the surplus equated to equal. We needed 700 million less surplus last year, and that's why we paid it, returned more to the Treasury. Does that answer your question?
Why wouldn't in the case if you're reducing your capital here in this district, why wouldn't it just land on another district's balance sheet instead
It did. So in essence, yes, our capital went down, our surplus went down. We, in essence, returned that to the Treasury. What happened in another district is their capital went up, they retained more for surplus, and when they did that, they actually paid less to the Treasury. So at the system level, it all kind of nets out to the same, but yeah, so it's just kind of transfer between reserve banks. Any other questions on our statement of condition or balance sheet?
Can you go more into what makes up the foreign assets and swaps?
Sure. So, there's two things there. So foreign assets, it's roughly the 700 million we held at the end of 2010. We've held foreign assets for a long time. Typically, it's if we wanted to intervene in exchange markets, which we haven't done for a long time. So they're just kind of holding a small amount there. So the difference between 2010 and 2011 is what we call foreign currency swaps. So we have 3.9 billion, so about 3.1, 3.2 billion is currency swaps. If I go back to my graph, you'll notice the dark green on is our currency swap. So it's this right here, and then it's up there at the top at the end of 2011. So those swaps have been entered into a couple times, and there are arrangements between central banks. So in the main case, it's the U.S. Federal Reserve System with the European Central Bank. In both cases, there was demand for dollars overseas, and to meet that demand, we entered into these swap agreements where basically we gave them dollars, they gave us whatever their currency was at the exchange rate that date. At that point, we entered into agreement to reverse that on a certain date at the exchange rate, at the same exchange rate. So there's no interest rate risk or exchange rate risk there. We also collect a fee on that, so it's a swap to give them to meet the demand in their country or their area for the U.S. dollars. So,
am I correct that those arrangements are done at a system level, not at a reserve bank level?
Yes. So once again, the New York Fed kind of enacts those on behalf of all reserve banks at the direction of the Open Market Committee. Other questions on our statement of condition?
So do we have does the Minneapolis Fed and all the Fed banks have Federal Reserve banks have a capital requirement? So when the capital is impacted so dramatically because of changes in merger activity and whatnot, what kind of does that have any? I mean, I imagine reserve banks are a special animal. And
good question. I was waiting for this one. So what kind of capital should the Fed hold? Our practice is our capital is based, first of all, the capital paid in is based on member banks. So that's just it's the half of the number up there, it's the 110 million. So the question is, how much should we retain as surplus? And our practice has been to retain an amount equal to our capital. 100. So here we hold on 110 million. Should that number be higher? Should that number be lower? You know, in some ways, capital needs for the Federal Reserve are different than any other institution because of some of the capabilities we have. You know, we have significant amounts of income, and we've always made income. I don't see that changing. So it's something we've talked about, but it's, you know, if we did have a loss or some type of needed funding, we would withhold payments to the Treasury until we made that up. So it's a good question. No, Toby, you have anything to add to that? Or?
Good job.
Okay. Yes.
Could a district bank get itself into a trouble where it would like go under?
When
like
you say
run out of
district, you say
liquidity?
Federal Reserve district?
Right, like the 10th district gets into trouble. Is that theoretically possible?
Well, I think theoretically, I'll let everyone know. I think this is where this disclaimer at the start of the program.
Yeah.
You know, if there were fraud or something, or which is not going to happen because we have the controls we have, so it'd be very difficult to do. I think, you know, one thing the Fed takes a lot of very seriously is integrity and credibility, and so we have a very elaborate internal control system and an ethics approach. So beyond something like that, I really see it very difficult for Reserve Bank to go under.
Yeah, let me just add, this is a little bit inside baseball, but it's sort of interesting. Among the reserve banks, we have what we call an insurance agreement. So if there are significant losses, let's just say a huge capital loss, the building burns down or something like that, we can share those losses among the district banks. We generally self-insure pretty much everything that we can. We don't buy insurance for things because you know, our loss experience has been very good, and we end up basically, you know, you pay more for insurance, and instead of, if you've got the wherewithal, the wealth, self-insure is what we do. And so we can use that insurance agreement in the case of very large losses. Quite honestly, we've never drawn on it. It's never been an issue. Hold on, Linda's got it, we'll get to you too.
You know, one other thing to think about is if you think about the amount of earnings that we have, it's way more than our operating expenses. I mean, by a pretty big magnitude. So it would be hard to envision kind of that insolvency type of thing that maybe you're asking about.
Yeah, it's roughly 90% of the income is returned to the Treasury on an average basis. So.
I got a lingering question on that currency swap.
Yes.
I mean, I don't imagine the Federal Reserve's in the business of currency speculation. Why would those swaps, typically what would be the reason for those swaps if people would need dollars and they can't just use their own currency?
So the issue has typically been in Europe, where a lot of corporations over in Europe have demand for dollars for their needs. So it's the demand for the dollars over there. I can't really speculate why there's demand for dollars and not euros, but there's been demand for dollars in other parts of the world. And so that's why we've entered into those agreements to keep liquidity. Toby, you have anything to add on that one? Or?
Yeah, so as you probably know, Europe has dealt with crises as well. And during the heat of that crisis, there could be kind of a flight, but with the swaps that we're entering into, we're with the central bank of Europe. So we were basically guaranteed to get the money back. And in addition, we did get the money back because if you look back at the number, it's gotten really small in the last couple months, even though it kind of went up during the end of last year. And again, it was a policy decision made by the FOMC. The question is related, is their currency backed by gold or oil or anything? No, it's a fiat currency as well as our currency.
Hi, you might have started to answer my question when you mentioned the Central Bank of Europe, or Euro. I was wondering if other countries have central banking systems like ours, and how they're doing right now, how they compare.
So most countries have a central bank. I think almost all countries have a central bank. And most of those are fiat currencies. They're not backed by gold. There's not an international gold standard among them. And really the judge of how well they're doing, it relates to their primary purpose, which is financial stability and low inflation. And so when you look at countries that have high inflation, those central banks aren't necessarily doing their jobs, and the people might vote with going to a better money, which a lot of countries use our money for their transactions.
Another comment on central banks. I began with sort of a series of hopefully interesting remarks about what else the Fed does besides monetary policy, payment services, bank supervision. That's where you see some differences among central banks. There's some central banks, for example, the Chinese central bank, they don't have their supervisory authority together with their central bank. Likewise, payment services may not be part of the central bank's responsibilities. So that's where you do see some difference. And then also, I think the pretty unique characteristic of the U.S. central bank is a decentralized structure. Oftentimes you'll see a monolithic central bank in one city or one part of a country, but the sort of the federalist approach that the U.S. central bank really tracks the state federal approach that we use for our government. Same idea was tracked when the founders of the Federal Reserve System in 1913 were thinking about what we should do. So that's a pretty unique structure among central banks as far as I know, Toby, unless you're aware of any others that have something like that.
No, very good points.
Yeah. Other questions, yeah.
You had mentioned China and other foreign governments. Now, I imagine they buy like a T-bill, or when they make an investment in the country, generally, how do they do it, and is it reflected here on the balance sheets?
Okay, so I mean, it might be useful to talk a little bit about, the fact that the Chinese owns a fair number of the Treasury securities, Toby. You want to talk a little bit about that? And then in terms of the balance sheet, Paul, that's not really reflected here. We're sort of
These
agnostic
are ones we
as
own,
to the buyers.
These are Treasury bills we own, so
Right.
our balance sheet. So any that China owns is not on our financial statements. So.
Okay, so questions regarding the central bank in China and how that all works. Well, what they decided to do was to try to peg their currency to our currency, which has a lot of advantages because basically foreign exchange risk gets reduced for businesses and transactions and trade, which is beneficial for both countries. The problem with that is they give up a lot of control that they have over their money supply. And if they have a situation where they're bringing in more dollars than they're sending out, they might take those dollars and invest them in dollar-denominated assets like U.S. Treasury bonds.
We have kind of reached the point where you have a little summary slide, Paul. I mean,
Yes.
you want to talk about that, and then I think we should open up for any questions whatsoever you have about the Federal Reserve. And maybe you want to talk through this quickly, and then we'll move on to
So
that.
just to summarize, related mainly to financial statements and financial information, we are subject to many layers of audit. So some have said we need to audit the Fed, and we say we're giving already. So our financial statements are publicly available. A lot of what we've talked about and the information is out on the websites, particularly the boards. There's links to that. A lot of information there. I talked about the system open market account and the role the New York Fed plays at the direction of the Federal Open Market Committee. That information or those assets, expenses, income is allocated daily to reserve banks. It's the key component of our statement of condition or balance sheet and the income for the Federal Reserve. We make weekly payments to the U.S. Treasury of our net earnings or excess. Capital, as we talked, is based on membership, not really to fund operations. And the key one for you accountants is Federal Reserve notes or currency. The only place in the world that's probably not an asset is at a central bank where it's a liability. So that's a quick summary of what we talked about. As Niel said, we're glad to answer any questions on that or any other topics or related to the Federal Reserve. We've got one.
I have one. The U.S. Treasuries that are in the on the balance sheet, does the Fed buy them on the secondary market from individuals and therefore putting money in the hands of the economy, or do they buy them from the Treasury at auction and give money to the Treasury?
Typically, we buy them from what we call primary dealers, which are financial institutions that the New York Fed has made arrangements with. My understanding and my belief is I think they can be both at auction or else, but other from other in the marketplace, so to speak. So that, yes, that money is going to those primary dealers, and then, which are financial institutions, and then, you know, they'll use it to meet their needs, and you know, so if there's a business need for it, it's in the system. Here you go.
Thank you. First off, let me say this has been very interesting. I appreciate this opportunity. A term we've heard in recent years is stress tests. Does your staff perform those stress tests? And what does that mean? Does that mean you go to the bank and break apart their loans into different categories and decide which ones are most vulnerable to the risk in the changing economy?
We do that. I'm looking to Niel or maybe Toby. Niel might have more.
You did a nice job.
Yeah.
You know, the thing that we saw, particularly in 2008, when firms either face capital stresses or asset quality stresses or liquidity stresses, where, you know, for one reason or another, markets have tightened up, that's when those firms are the most vulnerable. So when the Fed has always gone through a process of stressing a bank's operations, stressing the balance sheet, seeing what happens in changes in the economies you're describing, I think there's been an increased attention. There's a series of stress tests that the Fed went through with the other federal bank supervisors, where in particular went into the largest institutions and put them through a set of paces, a set of examples that took not just sort of ordinary or even sort of ordinary or even somewhat stressful, but very stressful environments, stressing their balance sheet, stressing their assets, seeing what happened with respect to the quality of those assets, with respect to any liquidity concerns. So that has been an increased focus, especially post-crisis, given, you know, the concern that people had. You know, we saw what happened during the crisis. There was, you know, certainly these lending programs, the TARP capital program that was done by the Treasury, where, you know, I think everything else being equal, people don't want to go through that again, right? So the idea is to try to prevent that by having good quality supervision, stressing their portfolios using these stress tests as you're describing. So I think, you know, I kind of added a little bit on to what you said, but I think you had it pretty darn close.
They did too. It was not only our supervision and regulation area was involved, but our economists were involved too, to kind of model, like Niel said, okay, what if these severe conditions happened? What would that mean to the financial institutions? So it was kind of a real collaborative effort on our part in working with the financial institutions.
The question, we have one in the back here.
I notice capital is based on membership, so local banks do not have to be members of the Federal Reserve, is that right?
It's state chartered. Some banks are state chartered and some banks are national chartered. So if they're national chartered, they do need to be a member of the Federal Reserve. If they're a state chartered bank, they do not have to be a member. They can choose to be a member or not.
Do they have a choice between being state or national chartered?
Yes.
Yeah, they do. So yes, they do. I mean, typically, obviously, a smaller bank's going to have that option more than a larger bank. But.
And what are the advantages of being a member? Or
Well,
not
one good
being a
advantage
member?
is to get a nice dividend.
Yeah.
A lot of it has to do with supervision, too, and I'll let Niel.
And there was a day, you know, if people kind of start to move out of here, too, I want to take a quick moment just to thank everybody for coming. I mean, this was a bit of an experiment on our part. We did these Bernanke lectures in March, and we honestly had not really opened our doors up to the public to do this kind of thing. And so it's really useful to hear the kinds of questions that you're asking, because that helps us communicate better to the public more broadly. Certainly the Federal Reserve is all about accountability and communication, and I think we benefit from hearing from people. So if you have a minute, I want to do a little advertisement. Fill out the survey. Any comments you have about Paul's presentation or Toby's response to your question or my response is Niel Willardson, feel free to call us out by name or not if you want to protect the innocent. But you know, we're just trying to do the best we can in responding to your questions and being responsive to the public more broadly. going back to your question, I'll see if I remember it after my little talk there.
Advantages or
Advantages
disadvantages
or
to the
disadvantages.
state
There was a time in 1980, before 1980, where to have the benefit of Federal Reserve services, to have an account with us, to have access to our Fed ACH services or wire services, you actually had to be a member of the Federal Reserve System. There's an act called the Monetary Control Act of 1980 where it basically said the Fed has to offer its services to everybody, to all financial institutions, and we do that on a price services basis. So they basically have to pay for that. We charge them in an amount that basically is equivalent to our costs, plus we include an imputed profit so that we treat ourselves basically like another financial institution selling those services to them. So in that way, the advantages, I mean, people might say, well, if I'm a bank in Minnesota, the Federal Reserve's right there, I can at least find my supervisors. But the FDIC offices, there's an office here, and the Office of the Comptroller of Currency, other supervisors are also here. So I don't think there's really, people might say the Fed does a better job or maybe not as good a job as other supervisors. It depends on that own bank's experience. So I don't think that there's any real inherent advantages other than, as Paul suggested, this dividend, which is not large dollars for most institutions, honestly. And sometimes, right now that 6% dividend is a statutory dividend. I think we'd all take that. At a time when, interest rates are higher, that's not as an attractive a dividend. And they can't also, as Paul suggested, they can't juice that up by buying more Fed stock. It's based on a calculation, and it's 3% of their capital and surplus. Let's answer other questions here.
You said there's oversight. Is there a punishment that you give banks that are part of your members? I mean, how do you? There's oversight. What do you do if the bank is doing?
Yeah, let me talk about
something?
that. So, there's two parts of this of institutions. We have what we call member banks. These are people that are members of the Federal Reserve System that receive this dividend. They're national banks and state member banks. Of those institutions, we only supervise one set of them, state member banks. These are the institutions we have oversight of. So we go in and we kick the tires on how they're doing. We go in and examine those banks typically every 18 months. If they're in not great a condition, as great a condition, might be every 12 months or even more often than that. We can do things like force them to take certain actions under the law that requires them to improve their capital, or in some cases, in really dire cases, change out their management. And we do that through what we call enforcement actions. They can be informal, where we write an agreement with them to say, you're going to fix this stuff, right? Or we can actually bring action in court against them and say, you know what, you've got to fix this stuff because your condition is such that you need to take some extreme actions right now. And those are all authorized by these various banking laws and statutes, especially many of those came to fruition following the savings and loan crisis that people remember in the 1980s. A lot of those laws, like the Federal Deposit Insurance Act in 1991 and the FDICIA law in 1989 came after those, and that gave us and other regulators, the Office of the Comptroller of Currency, the FDIC, various enforcement powers. It's a long answer. Sorry about that. Paula. We got a ringer, yeah.
I have a kind of procedural question about the financial statements. Those are all whole numbers on those statements, and you're talking about millions of dollars, and
Yes.
I'm just wondering, when you're rounding up and down, what's happening? Are there big chunks of money getting cut off or added on? And at what point in the calculation process is the rounding happening?
Do we have room for Paul in the financial management group, Paul? I mean, this is,
Wow.
she sounds like she loves this stuff.
We do it very carefully. You can help us. Right. So these numbers up here are they're in millions, obviously, in our financial statements. So we do round. Obviously, we take your typical rounding convention. Sometimes if you round numbers and they don't kind of give you the same total, if you just added them by sight at a higher level, usually we'll just offset that in like an other expense or another liability number. That's typically what accountants do is take the least. Did that answer your question there? Or?
Of like simplifying the statements for publication, or?
Yeah, it's just easier to read, I think. So if we had like
So are you balancing the penny, Paul, when you're in your office? I mean, in
Yeah.
the stuff that you do?
No, I don't usually do that.
Well, not you, but are we?
Yes.
Yeah. So in our account statements, we're going down to the penny.
Oh yeah,
where
so
we're displaying them.
all of our systems go to the penny.
Okay.
And they're balanced to the penny. But just for publication and ease of reading, And really what's important is, it's kind of, we just trunk, which is a common practice. So it's only when we publish like this, we'll round it. And typically it actually works pretty easily, so.
So we're tweeting this tonight, and we're getting some comments and questions
cool.
from
All right.
Twitterverse, some of which I can actually repeat. And we have a question regarding central banks and how other central banks operate in terms of monetary policy. I think that's the gist of the question. So I don't know, Toby, if anyone can answer that. If you have an example, like maybe how the Bank of England works or the Central Bank of Europe works in terms of...
in terms of what?
How they conduct...
How other central banks influence or process as a central bank.
One thing we could speak to, Toby, is coordination among central banks. We talked a little bit about the central bank swap point that the woman here in the middle of the room made, but how about coordination among central banks? Because I think that's linked to the question that Paul's raising.
Yeah, part of it is that a lot of the central bankers meet every year or every couple of years just to make sure that you have harmonious policies throughout the world, that you're not doing something that would hurt you in the end because you're going against everybody else, let's say. But in regards to how central banks operate, there are differences in terms of what their objectives are and how those objectives are met. So for example, New Zealand had a pretty strict inflation target for their central bank. And if that central bank president didn't meet those targets, he was basically punished, he or she was basically punished. And if they did make the targets, they get rewarded. Other places might have more political influence. So there's always the talk about, let's say, Argentina, where the central bank president is basically appointed every couple of years and doesn't have much political freedom or much independence from the political process. And everybody likes it when the central bank president gives a bunch of money out to everybody. And then when they find out that money is worthless, they get really upset. And then that president gets fired, even though the political process will say, oh, it's the central bank's fault, not ours, even though we're the ones appointing the leadership. So across the world, there's a lot of different nuances among central banks.
Isn't our dual mandate a little unique too, that we don't only have an inflation objective, but a full employment objective too?
Yeah, which makes it kind of tough because as a central bank, you have a lot more control over prices than you do for employment. Monetary policy can affect labor markets, but there's a lot of other factors that affect labor markets. Whereas over time, the central bank has a lot of control over overall prices and inflation.
See if there's some other questions here before we close out. Yeah, hold on.
There's one back there first. Do you guys have any stake in like the IMF at all, the International Monetary Fund? Are you guys involved with that at all, or how does that work?
Tangentially, we are. Excuse me. We do not. The United States is a member of the IMF, and periodically the IMF will issue what's called a special drawing right to member nations. And if you go back to our balance sheet, the second item up there is special drawing rights certificates. So it's another thing where the U.S. government has wanted to monetize those special drawing rights. So that's as close as we get to the IMF Fed Reserve, but the U.S. government's a member of the IMF. I think we got one here.
I have a brief question. With respect to the Ninth Federal Reserve, are we a net importer or exporter, first of goods and services? And secondly, with respect to investment, does the world invest in the Ninth Federal Reserve District, or do we invest other places?
That's a very good question, and I don't know the specific answer to that. Our accounting systems that we build, we have national income and product accounts, so we can do consumption plus investment plus government plus exports minus imports at the national level. But the way we account for it at the state level, state GDP, is we build it up from the bottom. We say X number of dollars came in from, or value added was added from agriculture, and X dollars was from manufacturing. So we kind of build it up on that side rather than the national, which deals with exports and imports. So we don't have a good way to capture whether we're net exporters or importers. But given that, there must be some studies out there or some analysis that was done that I'm not aware of that would deal with that issue. So that sparks an interest in me to find out the answer to that.
Okay, I have a question back here.
Yeah, it's my understanding that the quantitative easing is really a word for the Fed buying up U.S. bonds because other buyers are not available because the markets are either overextended or dried up. Is that rationale basically correct? And if it is correct, then it would seem to me like, number one, it saved the country an awful lot of money because the profit return on those bonds goes back to the Treasury rather than to some foreign nationals. And if this program goes on and remains stable, why couldn't quantitative easing essentially in large part replace the bond market in New York?
So if you take a look back at this picture again, you'll see where the quantitative easing hit, those kind of two separate points. And so if the scenario that you laid out, that the Federal Reserve is just helps propping up the government by buying the government bonds over time because the government can't sell bonds, then you would think it'd be kind of a gradual thing or what have you. But you see, it was a purposeful decision made by the Federal Open Market Committee to say what's best for monetary policy and what's best for the country, not for a consideration of whether the government can sell their bonds or not.
We have another question from the Twitterverse regarding the Financial Services Oversight Council created by Dodd-Frank. Do I have that right? Stability Oversight Council, FSOC as we call it, and to what degree and how that new agency, if you will, helps the Federal Reserve. Yeah, helps in terms of systemic risk.
Yeah, let me try to take a shot at that. So there's, you know, the crisis, I think, revealed a number of concerns about the system, the financial system, and one of which was actually talked about a bit in a book that was completed by Gary Stern and Ron Feldman here locally back in 2004, a book called Too Big to Fail, The Hazard of Bank Bailouts, and that was published well before the crisis. And the Dodd-Frank Act was the law that passed this Financial Stability Oversight Council. And it's basically a council that consists of U.S. regulators and other overseers. It includes bank regulators like the Office of the Comptroller of the Currency, FDIC, the Federal Reserve, also includes the SEC and a number of other financial institution regulatory agencies. And the whole idea of that agency, or that council, is to really understand what's happening with these systemically important institutions that became such an issue really in the 2008 crisis. It's one of many mechanisms in my mind that help us give us a little more confidence, hopefully a lot more confidence, that we won't have a reoccurrence of the too big to fail situation that occurred in 2008. I think some other things like the stress tests that bank supervisors go through also add to that. There's also in this Dodd-Frank Act, there's a provision that basically calls for the resolution of large financial institutions. During the 2008 crisis, there were a lot of people that felt like we couldn't take a large institution through bankruptcy because basically the system would freeze up, there'd be panic. The whole idea behind a number of provisions of Dodd-Frank, including like the Volcker Rule to limit risk-taking in large institutions, is try to reduce the overall risk in these very large institutions that have become part of the fabric of our financial institutions. That's a big challenge right now. And this financial Stability Oversight Council, I think is part of the formula for trying to respond to that, is maybe the best way to put it. Okay. How am I tracking in Twitter world? Did I get a thumbs up? Did I get a like out of that one? You know, before everybody leaks out here, I want to just thank everybody again. Please fill out the surveys. We're going to stick around for a bit if people want to, you know, catch us here after this class. Certainly, if there's some other things that you're interested about the Fed, feel free to write that down in the form. We'll try to do more of this kind of thing. We are really committed to communication about what's going on in the Federal Reserve System, the economy more broadly. We're planning to do more things like this, so please continue to watch our website. We'll put those out there, and we just can't thank you enough for coming tonight. So thanks very much. Bye now.